Hey guys, welcome back to the After Hours. I'm the 8-tailed beast, and today we're going to talk about fundamentals in the market. Before we get into it, I'd like to say it's earnings season and we're in a temporary rally that comes from naked short sellers, apparently. So since we're going to talk about fundamentals, let's talk about the weakest fundamentals. Penny stock. Recently, there is a ticker called GNC, and GNC claimed that there was illegal manipulation of a stock that brought its stock price below the NASDAQ requirement, which is $1. And once they said something about it, other people came out of the woodwork and said they're experiencing the same problem. Now what they did was they hired an ex-FBI officer and they organized a special dividend to squeeze the naked short sellers out of their stock. When GNC did it, everything looked okay. Someone else that also hired the same people, they just showed how fundamentally and morally wrong penny stocks are. They started the morning with the pump and ended the day with the offering. And why do you think people hate penny stocks? So what do I mean by fundamentals? First, what does it sound like? Fundamentals sounds like a foundation or a basic idea. From another angle, it could look like an essential piece. Now, how does this play into the market? There are several ways that this game can be played, but first you have to learn the rules. If you want to get to the bottom of things, you have to play detective and sometimes doctor. Lucky for you, all market actions tell a story that can be pieced together to describe a behavior. If you follow the trail of crumbs, it leads to a philosophy of a small group of traders. Here's a gentle reminder. Stories and stocks are interpreted. Given enough time and imagination, they will evolve. It all blends together eventually, hence the need for guidelines. Anyway, first you should know how to read the market. There are two major schools of thought when approaching the market. Technical analysis is one. It's when investors look at statistical trends and visuals, such as movements in a stock's price and volume. It's a combination of numbers and candlesticks. On the other hand, fundamental analysis, another major school of thought, uses publicly available financial data. This data is recorded on financial statements, such as quarterly and annual reports. The three main financial statements are the balance sheet, income statement, and the cash flow statement. Fundamental analysts look for trends in current and previous financial reports. Each past report is backed by a separate filing to the SEC, such as the quarterly 10Q and the annual 10K. And there is also recent information from the 8K that has to be filed to track major events or the security. You're dealing with a fundamental problem, just like that penny stock that has bad fundamentals and apparently bad morals. You'd be lucky to escape the math. There are two types of accounting, accrual and cash. Most public companies use accrual accounting, which means the income statement is not the same as the company's cash position. Profitable companies can fail to adequately manage cash flow, which means the cash flow statement is a critical tool for analysis. In order to evaluate a company's performance, it's important for investors to take into consideration revenue and earnings. While revenue tracks the total amount of money made in sales, earnings reflects a profit after expenses paid for the current period. This makes up the top and bottom of the income statement. Analysts use the information from the balance sheet or the income statement to find financial ratios. Told you we get back to math. Now, financial ratios are essential to solid fundamental analysis. They look at common ratios such as net profit margin for profitability or price to earnings for valuation. For instance, it's earnings season and the market just came off of a $1 trillion rally as they fight the Fed again. I promise we're still in the bear market. So this week we had a report on a few major banks: Morgan Stanley, Wells Fargo, and Goldman Sachs. Everyone expects negative results, but similar reports. The earnings report read, Wells Fargo was down 50% in net income. Everyone expected something really similar. A few days later, when Morgan Stanley and Goldman Sachs came out, Morgan Stanley was down 40% in net income, and Goldman Sachs was down 66% in net income. All the bank reports showed that the pace of increasing expenses beat the pace of increasing revenue. Goldman Sachs results were so bad that it dropped the stock by 6% in one day. And on the opposite side of that, you had Morgan Stanley that went up 6%. Now, this is a milestone that hasn't been seen in a decade for Goldman Sachs. Using fundamental analysis, we saw evidence of poor financial health, but it's important to recognize the qualitative factors revealed in the lack of management quality and a potential bruise to a brand name recognition. When an executive pointed fingers at the overall market when investors wanted an explanation. Now, there was a huge difference between what happened in Goldman Sachs and what happened in Morgan Stanley. Fundamental analysts primarily search for stocks currently trading at prices higher or lower than the real value. If there is a real value, does this mean there's an imposter? Maybe. The real value is also known as the true or the intrinsic value. It's also a rough estimate because of the many ways it can be calculated. The intrinsic value formula that uses P and E ratios is quicker but not as accurate as the formula that uses discounted cash flows. The longer the formula used, the better the answer, right? Oh. The best estimate of a real value is when we combine both quantitative and qualitative factors. A quantitative approach gives a relatively hard number from a formula about the overall state of the economy, the strength of the specific industry, the financial performance of the company issuing the stock. Neither qualitative or quantitative analysis is inherently better, but on average, many analysts consider them together. It's similar to a crossover of technical indicators to affirm the forecast of a stock performance. If two indicators say you're going in the same direction and you go in the opposite direction, what happened? It should combine facts and formulas to create a current and previous estimate. The estimate shows where the asset should be based off the strength of the fundamentals. It represents a company's current financial health or the trend of its performance over time. It should not be confused as the current share price of the asset, unless you use discounted cash flows for a share price estimate. The goal is to find the opportunity between reality and the estimated value. Each quantitative factor gives insight into the financial health and business performance. However, sometimes financial health or business performance can't be expressed in numbers, which is why we need to recognize the qualitative factors from a company's key executive for management quality, or brand name recognition for reputation quality, and the current number of patents, licenses, or partnerships. All of these are essential in the growth and stability of a company and play a major role in fundamental analysis. All right, guys, it's time for wise words from Steven. I asked Steven one time, what do you think about penny stocks? He said, I love penny stocks. The reason I love penny stocks is when I see a spike, I know they're going in the wrong direction because penny stocks have trash fundamentals. They're always going to end at zero. And because of that, it gives me the confidence to hold any short that I hold intraday and only slightly less overnight. Remember, guys, risk management. All right, guys, that's all I got for you today. If you like what you saw, hit the like and subscribe button, and I'll see you in the next video. Peace.